Let's talk about Larsen Toubro, one of the outperformers in trade today on the back of very strong earnings. In fact, it is in just about 8 stocks or so that are gaining on the Nifty 50, second highest gainer, up as much as 2.8%. My colleague Pankaj caught up with the management, R. Shankar Raman, who is the whole-time director and chief financial officer of the company, and here's a slice of that conversation.
Yes, I think, as you know, hydrocarbon orders were a little muted about 12, 18 months ago. The low oil prices actually was not encouraging the investments. Plus also the entire shift towards this ESG and greener fuel and stuff like that actually put some brakes on the investment. But I'm glad to mention that the fallout of steady rise in the oil prices, even though at a country level it would impact us adversely, from a business point of view, I think it brings the investment rationale back onto the charts. So consequently, we find that the activity in the refineries and petrochemical space picking up. And a small evidence of that has been the order wins so far. That we have had in the hydrocarbon sector, both in the international markets and in the domestic markets.
Right. When we just talk about the infrastructure sector, sir, infrastructure sector for the third straight quarter, segment margin has expanded by 200 basis points. This is despite steel prices, cement prices, various other prices across the board going up. Is this the new normal? Has L&T found a way to beat the uptick in commodity prices in a very big way?
I don't think we should define it as a new normal because, you know, what happens in project business and particularly infrastructure projects, which are drawn over 4 or 5 years period for execution, the margins arrangement between the quarters depends on the progress that the jobs make in their execution. We have been historically following a very conservative way of accounting profits on all these jobs. Only when the jobs reach a certain margin threshold level, completion level, do we recognize the margin. For example, the margins are not recognized until jobs reach 25%. Another set of margins are released when the job reaches 50%, 75%, 90%, so on and so forth. So depending on the mix of which are the jobs which are reaching a certain margin recognition threshold in a quarter, we will have volatility in terms of margins. But given that we have a very large order book and fairly stable operations during the course of the year, on a year-to-year basis, despite the economic cycles, we have been able to consistently report steady margins, and that is largely because of the scale at which we operate. It is true that in the particular period, last 6 months, we've had headwinds in terms of commodity prices, input costs, huge transportation cost, rising oil prices, hence rising energy costs and stuff like that. But you know, in project business, there are several levers that are at play. When we bid for projects, we bid with some inflationary assumptions in the jobs because we are anticipating cost 3 years, 4 years ahead of time. So it is not possible to bid for jobs pricing it at the current cost. So some amount of inflationary elements exist in the pricing. Secondly, almost 67-68% of our contracts have price variation clauses inbuilt. And that is the nature of the beast. I think all these long-drawn infrastructure projects have this contractual flexibility to readjust the input prices as we go along, of course, based on some transparent, well-understood indices. So that also actually comes in the way of helping some amount of stability to the margin when we are talking about periods of high inflation, as we have seen now. The third is, of course, we have what we call as star price contracts, where the input prices are mapped one-to-one. And hence, to that extent, I think the clients takes the responsibility of the cost pass-through, either up or down. Of course, we then have a certain portion of the contracts, maybe 10 to 15% of the contracts, which are open, which means the exposure on account of inflation does affect the margins. But in the last 6 months or so, I think we've had a fairly favorable mix of projects which have been able to tide over this margin, the margin stability, tide over the headwinds on inflation, and provide stability to the margins.
Right. How would you look at the Capex cycle in India? First time there is optimism regarding materials, there is optimism regarding infrastructure, money is flowing to the road sector, to the real estate sector. How would you look at the optimism in and around that, and how is L&T placed to benefit and gain much more from that?
I think, as I mentioned in an earlier conversation, the tendering activity has picked up during the course of the year. We had almost 150,000 crores worth of bids, tenders that were put out in Q1 of the current year, and about 2 lakh crore worth of tenders put out in Q2. So to that extent, I think there is a certain momentum that is building up. The country is also committed to build the infrastructure. They've also attempted to part finance this build up through asset monetization program, etc. Many of the infrastructure projects are also funded by multilateral agencies because they see as a good opportunity, because India needs this infrastructure badly. And India has been a stable market by and large, and international agencies have not lost money in India. So I think there is a certain amount of optimism among the funding agencies to fund these projects. So consequently, I think the levers that favor investments have improved. The fact that material prices, etc., have gone up has provided a certain, wings to the minerals and metals sector and derivative sectors, because they do see an opportunity to expand capacity to take advantage of the favorable pricing that's available in the market. So we see some investments there. The huge growth in the IT and technology services sector has brought into play some amount of capacity augmentation, even if we are now given increasingly to believe that it will be a hybrid system of working where some people work from home and some people work from office. But nevertheless, the growth momentum in the sector has created opportunity for us to look at some investments that are being made in that sector. Another area where a lot of investment are at least getting spoken about is in the area of data center. I think India, given its movement towards clean green energy and given its capacity to house large data centers, the global hyperscalers are looking to India for hosting their data centers. And the government is also increasingly pushing the digital agenda. And given the fact that there's going to be data privacy and data residency issues, I think India will see an opportunity in the build-up of the data centers as well. These are over and above the traditional investments that take place in the area of water, in the area of transportation infrastructure, particularly the urban transportation, and in the area of power distribution infrastructure. So the social infrastructure is getting built. The programs, large programs like the high-speed rail, etc., has created an opportunity for a lot of ancillary investments that need to happen. For example, along the railway corridor, we need onloading, offloading terminals. We need warehousing infrastructure to build up. We need hub transportation that needs to happen. So all of this as a chain reaction create a potential for investment. We do look at this space with a lot of optimism. From a 3-year, 5-year perspective, I think India has a lot to gain through these investments. The only point that needs highlighting is it has to be built efficiently. I think we cannot afford the kind of delays that happen once the project is announced. The competitiveness of the infrastructure is key for India's own economic relevance in the global marketplace. So consequently, we do hope that the government and the recent announcement of Gati Shakti, etc., is an indication that the government is serious about monitoring implementation. And if this really plays out well, I think the next 4-5 years, I do see India in a very good place as far as investments go. L&T is remarkably well placed in all of this because of just the width of the infrastructure capability and the engineering capability it possesses. So consequently, any of these areas which will see investments traction would benefit L&T in a significant manner.
Right.